Go for it.
Hi, it's Simon here from Sydney. So two questions. Firstly, you talked a lot about simplification.
Yeah.
You put into this, you showcased that in the whole day. Clearly, at the same time, you're talking about sort of expanding the price point architecture across categories, moving to RTD, moving to more pack sizes. So there's more complexity coming in to that side of the organisation, more SKUs. What are you doing to help your customers manage that transition? Because obviously you don't operate in a vacuum, but the players are also increasing SKUs, makes the whole system more complex. How do you win and make sure you get appropriate share of shelf there? Yeah. That's my first question.
Okay. And Ewan, I'm going to probably ask you to augment what I'm about to say. Simon, ordinarily, I might directionally agree with you. In this case, it's not the case. If you look at the complexity we have today in terms of SKUs, and you look at the complexity we have today in terms of innovation, it's colossal. It's colossal, right? So 1,200 innovation projects in Diageo in a year is colossal, right? So actually, I told you about the session we had with the marketeers. The project size is going up as we cull that portfolio. The SKUs are going down as we simplify. So actually getting bigger, more impactful innovation, whilst it is, yes, in that portfolio or it is in RTDs, overall, we're taking a massive amount of complexity out of Diageo as we make these changes. But it's very important that we've got a strategy that allows us to make those decisions against it. But Ewan, you wouldn't believe the complexity in the organization today in the things that you've just mentioned. So I'm really very confident we're going to be a much simpler business as we go through this change with better innovation and better productivity by project and by SKU. But mate, do you want to add to that?
Yeah, sure. I mean, look, I think the innovation one is one of the best examples. So if you look at what we spend our time doing across the value chain when it comes to innovation, we're always chasing where we haven't necessarily got the capacity deeper in the value chain, and you're trying to solve and establish it. And a lot of the resource and effort goes into kind of problem solving. That's something supply chains are typically quite good at, but the relationship with time means it typically extends. It needs a lot of resource. This kind of like approach which goes more into the simplification of the operating model, from the language to the accountabilities to the integration on an end-to-end basis, is such a big simplification. I've been in the organisation 30 years. It is a massive kind of tying together of how the business makes decisions. Thank you, mic's on. And essentially, I believe deeply what that's going to do is essentially make sure that our resources are more focused on saying, as you develop an innovation, you are setting it up with confidence from its inception, and the accountability is through the business to the delivery to customer, not that you develop things and then it gets thrown over to supply to solve how you scale it and deal with all that complexity of scaling it on time for the customer. So it's just one example that can be kind of played across even the business planning that we spoke about, where essentially you're planning for many things that are never going to be a reality. And therefore, I think having a much more streamlined portfolio to then play it across the price ladder, it just means that you're much more confident then the decisions that you take will play through in the reality or the activation of our value chain. So just a couple of examples.
And Simon, I think I'll just add on the piece that Ewan was talking about, and particularly from a customer perspective. I think we also are getting much better in terms of our offering that's occasion-based into the outlet, and a brand pack architecture that works as well, right? And you heard Alvaro talk about that in terms of how important that is as well. So in fact, we're bringing for simplification to them too in terms of what's relevant and what's going to move, right? With a broader offering of what we have on packs, formats, that is occasion-led and channel-specific.
Okay. Sonya, how do you want us to do this? What's the best way? Yeah, why don't you... Yeah, go for it. There you go.
Thank you, J&B my question is on the US. First of all, you expect the market to reaccelerate from -3 to flattish. What's driving that? And I think one of your competitors was talking about a market at -5, so I don't know if you could help us reconcile those numbers. Can you talk about, when you think about the growth of your performance and closing the gap in market share, how we should think about price mix versus volume. And then lastly, I think SG&A to sales in the US is 6 or 7%, if I am right, the overheads. How do we think about organic EBIT in the US if you are going to be negative negative until you're flat 29? Thank you.
Why don't you take the last one and then we'll ask Anna to come back on.
So on that last one, if you look at our algorithm of circa mid-single-digit growth on the operating profit, that is assuming with what we have already put into place that John has moved on the operating framework. A lot of those savings will come through in 2027. But again, remember, top-line growth down mid-single digit. So our assumption here, again, I'm not giving you broad direction, but assumption here for North America underlying that mid-single digit operating profit CAGR is low single digit down for the next 2 years, and then getting to a flat to slightly positive in year 3 on operating profit for North America. Okay, so we're not expecting that there's suddenly going to be great profit growth coming out of that, because we've got to invest for that capability, that simplification, and that competitiveness.
Yeah, indeed. Anna, do you want to come back on the... Yeah, go for it. Oh. No, can we put the mic on, please?
Is it on now?
Yeah.
Yep. So I think from the consumer perspective, we were quite clear in North America. There is a significant affordability pressure that is the major headwind right now. That therefore is a discretionary income challenge. You're especially seeing that in the middle income, where they have the deficits. So as macros return, as consumer sentiment returns, we'd expect discretionary income to come back, and we would see then higher spend on alcohol. So it's that series of events that needs to come through, along with, as I said earlier, if population changes, if the immigration piece changed, we'd see additional tailwind as well.
Yeah.
Very good.
And the number you referred to of that 5%, but that you said competitors, that's really more on the US spirit side. Remember the number that Hannah's put in for North America is total.
Yeah.
So it also factors in, what you're looking at in terms of beer, Canada, etc.
Yeah, indeed. Oh, okay.
Am I on? Right, so sorry, it's Mitch Collett from Deutsche. Nick, in your slides on marketing, I think you showed that most of the reduction in marketing in fiscal 26 came from that non-working money. And then the guidance you gave in terms of organic sales growth looks, I guess, quite prudent. I'm sure there was a point where you thought about whether the best creator of value would have been to reinvest those savings, potentially to try and get the top line growing a bit quicker, a bit sooner. So I guess I'd be really interested in your perspectives on how you came up with the right sort of level is about 16, and that's the sort of glide path to growth. And then, Dave, I think you probably won't want to answer this, but I think at one point you talked about there being 5 strategic alternatives. I'd be really interested to know what the other 4 were or what the 5 were, but if you can't say, I understand. Thank you.
I'm sure you would, but we won't be sharing those with you. So I just wanted to demonstrate the completeness of the exercise, that we challenged ourselves in a number of different ways, shared them with the board, but we make the decision, that's what we're sharing with you now. Can I start on the one you set for Nick, and then he can come back financially, which is, look, the critical thing is, let's look at our history. Let's look at the history of Diageo. We stepped it up from 16 to 18 in 21 to 25, roughly. Got no growth for it. Right? The reason why Nick is emphasizing, I think, so much that the 16 is an outcome is the way we're doing it now is we're taking the strategy, we're taking the brands, we're taking the innovation, to use the term, the jobs to be done, and then saying, actually, how much money do we need to extract the growth from the innovation that we've got available in this year, that year, and the other. And the outcome to that is 16. The idea that suddenly, without the right assets, without the right innovation, without the right time, that I could just take 16, turn it to 18, and accelerate the top line more quickly, too simplistic. Way too simplistic. So we now need to be much more surgical, to use the word, about the investment that we make in different parts of the portfolio to get the return that we want. It's evolving as a methodology for us. It's all quite new. but the outcome of that is that the 16 that Nick was talking about feels about right for the next 3 years, and we would actually destroy value if we were just spending more money on things that we know wouldn't return.
Yeah, I mean, the only thing I would add to that is, again, keep in mind, if you think about what you saw from an angle of what Christina laid out and what you heard in terms of the category strategies, right? We are talking about a more harmonized and standardized approach. So if you also think about the spend that was there, keeping aside the non-working element of the duplication and the waste that we had, there is an opportunity from scale and harmonization as you think about spirits and RTDs across those categories as well. So I think you have to look at it from an angle that says, back to the point, do we have the right assets and are we investing behind those assets with a returns focus? And clearly, if there's better returns and we can put some more in, we'll find the money, right? We're not going to not put the money in. But I think for now, we believe we have that.
Andrea from Bank of America. So two for me, please. An important lever for stepping up your commercial execution in the US is about re-energizing sort of the relationship with your distributors, and you referred to that in the presentation. So can you talk a bit more about some of the changes you're doing, also how you're going to incentivize them differently to focus more on rate of sale, and when are these changes actually taking place? And then a question on the balance sheet for Nik, please. You're maintaining the balance sheet target at 2.5 to 3 times. I mean, this has been the target for many years at Diageo, particularly at times before COVID when top line was growing mid-single digit. Diageo was targeting 5 to 7% EBIT growth. So what's the thought process in thinking that is still the right target in a more difficult environment? And historically, when you've been towards the mid of that range, that would have triggered buybacks. Is that the way to think about it?
John, do you want to? I can say something. Go for it.
Yeah, so look, in terms of our go-to-market, I would say we're very advanced in terms of our conversations. Look, the big thing is when I went to the US, I found that we have exclusive dedicated sales force, which I really, really like within our distributors, the distributor side of the house. But they were pretty much focused on points of distribution. And so the conversation we've been having with our distributors is, how do we take that dedicated resource and put them to work harder on not just getting distribution, but actually getting velocity and rate of sale driving, whether that's in how we merchandise, how we do shelves, how we actually drive the package into people's hands. And of course, incentives play a big part in that. I won't get into specifics because you can appreciate that. And I think that's a really important shift for our distributors. And I think it mimics what we're doing with our own internal model as well. That shift to distribution plus rate of sale velocity is going to be a really key unlock for us.
Mm-hmm. Balance sheet. So let me just remind you what I said. I said right now we believe that 2.5 to 3 times is the right leverage range. We review that annually as a part of the organization with my treasury team and with Dave. We have a finance committee, but we also review that annually with the board. All right. So this is not a static number for now, we believe. In the past, last year, when someone asked me, I said, does it really matter? I'm so far out of my range. Well, now I'm coming back towards my range, right? So it's a good problem to have for us to look at it. I'm not going to comment on what Diageo has done historically when they've got to their midpoint or what actions they've taken. All we've said is this is a nice problem for our board to have, to think about once we're well within range. Well, clearly, well within range could even be if we change it to 2 to 2.5 times. I'm not saying we are. It's a nice problem for them to have to think about how we return cash to shareholders. The priority of returning cash to shareholders is unchanged, right? So, but I won't get drawn into timing or anything else. I don't know if you want to add into that.
Definitely not. No, perfect. Please.
Chris Pitcher from Rothschild & Co. Redburn. 2 parts to the same question, really, Dave. One thing I'd be really interested in learning more about is how you're changing the culture of the organisation around planning and response. I was really intrigued to hear about the idea of forecast bias, particularly positive. I'm a sell-side analyst, I empathise. But Diageo has historically had a propensity for forecast bias. I was surprised to see in your sort of outlook that you've got the standard 2-point range across all the regions, because the industry is more volatile than that. Are you planning more extreme scenario environments? If the US stays down 3, 5, you know what you're going to do? Because mid-single digit is actually quite a narrow range to deliver organically. And then the second part of the question is, currencies are one of the structural problems in your business. What are you doing to reduce the currency volatility in terms of local sourcing, local production where it's possible, liabilities and so forth? Because you haven't talked about currencies all day, and that's ultimately what's quite often eroded the opportunity on the screen.
Why don't I take the first and you talk the second, and Ewan, please feel free. Look, I think we are making quite a fundamental shift in changing what we're looking for in terms of operational discipline and delivery across the piece. Giving you an end-to-end responsibility and being clear what value different parts of that end-to-end deliver in terms of that operational excellence is new in Diageo, right? So what we've talked about is what's the right way to make interventions, change the culture, invite the right behavior, right? And one of the very easy ones is saying to those 23 go-to-market organizations, actually what I need from you is a very, very, very good, the best you can do, quality forecast. Don't play any games. I want a rolling, so now I ask them every month, what's a rolling 12-month, by month forecast? Forget month ends, forget quarter ends, forget year ends, not interested. What's the right? So you are now, I will judge you, if you want to be like that, as a local managing director on your ability to read your market and forecast demand. What we think is a reasonable range is here. We've kept it really simple for the first intervention. We know there's more volatility in different places. If I'm honest, I would say Latin America's historically been one of the more volatile places, but the improvement that's happened there, been going on for longer, fantastic. Elsewhere, we've got other challenges. So it's about picking the right measure, first and foremost, inviting a change in behavior, but where necessary, putting the right discipline and the guardrails in if that's not being responded to in the way that we would want it to be. But by being able to talk about the end-to-end process, by being able to give the data that shows actually why have we had all of this wastage in our supply chain and what's contributing, that invites the right conversation to happen. So process by process, we've intervened ever so slightly differently in each one, but that's the exercise of how do we nudge the business to change. But the big thing is to give the responsibilities really clearly, which is why I talked about the operating framework earlier. Right? Currency.
So firstly, there is a mention of currency. It's just in the appendix because I didn't want to bore you with it from an angle that, one, when you look at it, and I want to separate out two elements. I'm going to come back to transaction exposure in a moment and then translation exposure. What we just put into the appendix over there is what we see at current spot rates, and right now it's pretty negligible, right? But that will continue to evolve. But let me come back on translation in a moment. Let's talk about transaction for a moment. And I say that because when I came into Diageo, and Dave and I are both very much aligned as we thought about this going forward, is there was, one, a confusion of the two, all right? And we were actually, particularly when we moved to US dollar reporting, we were actually hedging at cross ends with each other based on our supply flows or what was happening when you think about Scotch moves and sterling, tequila moves and the peso and the dollar, right? So what we've done is really gone to a netting process to really make that much simpler. But more importantly, with that netting process, we've also ensured that accountability lies in the performance management for each of the markets and the regions, all right? So that means more actions being taken based on not just a budgeted rate of what you're seeing, but actually a monthly flow through of what does that mean in terms of how transaction exposure is moving and how you're thinking about that from a competitive angle as well, and what do you need to do to be able to manage through that. On the translation piece, we're not going to get into speculative hedging, all right? But what are the actions that we're taking? A couple of things that we've done. How are we looking at liability management, and how are we looking at some net investment hedges to be able to reduce some of that volatility? That work is ongoing, but that's where we are.
Okay.
Olivier Nicolai, Goldman Sachs. Just two questions for you. Going back to RTD in the US, when would you expect to get the full distribution? And is it a critical element to improve your market share? And secondly, most of the leading brands in RTDs today are actually not necessarily linked to a spirits brand, and they are often owned by a brewer. How do you explain this? And I know you said no M&A, but would you need to do any small bolt-ons in the category?
No. Okay, so answer the last bit first. No. I think I'll give a marketing call, and John, if you want to add something to this, please feel free. I think the way I see North America is, as Mark said before, we were one of the first, if not the first, to start this category. We then backed away, deprioritized it for a number of reasons. Doesn't matter, it's history. I think, therefore, in North America, it left a space and others entered into it, and therefore you get these new-to-world brands, and you see the churn that is there in new-to-world brands. Some of them are successful, a lot of them are very short-lived. I think the question for us is, what is the opportunity in ready-to-drink, that consumer occasion, when you think through the lens of our brands? Right? What is it we have? We have fantastic, well-differentiated, market-leading brands, which, by the way, most people on many occasions make into cocktails. The opportunity, therefore, is for us to serve that consumer need ourselves in a very convenient way as part of that RTD movement and category. We've done it on some, we haven't done it on others. We think that's the opportunity. The critical thing is that we show up in those categories using our differential strength, and that's our brands. And we won't do any other brands until we've done our brands. So I'm not saying there won't be new-to-world brands, but we've got a massive opportunity, as Mark showed upstairs, to actually be much better about giving consumers what they want with our brands. Do me a favor, at the breakout, when we finally give you a drink, try that bullet old-fashioned he was talking about and see what we mean when we talk about real RTDs from spirits brands. That's where the growth is. That's where our brands sit. We just need to apply ourselves to it. I think in terms of distribution, John talked about it, there's definitely an opportunity. Two things I would say, and then I'll ask John to add on to it, is you should have got from everybody this idea that we now need to be managing RTDs as part of the spirit brand. Historically, Diageo has split that, and it's particularly prevalent in North America, given the two divisions that John was talking about. And if you're not careful, you end up having sort of internal friction between the two. So getting the brands together coherently, what John is doing in terms of the go-to-market organization will help us. Look, we've got great distribution on some. We've hurt ourselves with the quality issue we had on Casamigos, but we showed that we could get good distribution on that really quite rapidly. So the capability is there. We could do more, but put the brands together. What John's doing in the operating framework drives the distribution, and then the share comes from there. Okay? Why don't you just pass it along? And then we'll pass. Yeah.
Thanks for the question. I'm Ed Money from Jefferies. So I've got two questions, please. The first is around culture. I think in your final slide, you pointed to this importance of developing a very strong, robust performance culture. I guess the question is, where are we in that journey? And has this plan been solved internally to drive that followership? Is my first question. And then my second one is a sort of more philosophical question around, Diageo's been fantastic at premiumization over the last couple of decades. You're obviously pivoting a bit more to affordability with the small packs, with the RTDs, with some of the selective price resets, etc. You can do all of this with the same amount of A&P dollars, but do you need more salespeople? Or is it a case of giving your salespeople the right instructions and just doing more with the same?
Okay. Look, where are we in terms of culture? I think, and you should ask people who've been in Diageo longer than I, and you'll have chance over a drink to do that. I think the desire to have a performance culture, the desire to improve performance. I've been really very encouraged with what I feel inside Diageo. People are disappointed that we've not been performing better over the last 4 or 5 years. There's been a thirst for change, but then there's the difficulty of making the change. So we're definitely at a point where we're going through. Most of it is behind us in terms of the go-to-market, but in Europe, we've still got the consultation that I shared with you at the start. So I would say we're in the early stages of building that performance culture, but the wind is at our back in terms of what it is people want. We just need to be clear and support that performance culture, and that's what all the things this morning were about. When you talk about I look at the portfolio you just described, and that feels much more balanced to me than the one you described before. As much as I love the premiumization, and trust me, we won't step away from it, actually the portfolio of all the things you mentioned feels more robust. And actually, I don't worry at all that we don't have the money we require to be able to do that. And I think if you go back to Mark's presentation, he talked about those focus markets and in the Guinness presentation, certain markets, we are putting more feet on the street. Depending on the model, Diageo in Europe has put more feet on the street, be it Guinness or indeed some of the on-trade. In John's area, so where it returns and where it adds to that portfolio, if that's the right way to do it, that's the right way to support the brand. It's not A&P in the way that we traditionally talked about it, but the flex is there in the portfolio and the money is there in the 16% that Nik highlighted. Okay? There you go.
Sanjay Aujla from UBS. 2 from me, please. Firstly, John, when you've diagnosed the issues on Crown, Smirnoff and Captain Morgan, did you ever think that the brands are taking too much pricing versus their competitive set, or are you happy with the relative price positioning on those brands, and it's just more a case of packaging and other things to fix? And my second question is just coming back to the medium-term algo. Dave, Nik, if you're exiting by fiscal 29 with 3% organic sales growth, and by that point, if the cost savings are done, is the business capable of still delivering mid-single-digit organic EBIT growth and EPS out of that?
I love it. We give you 3 years and you want the 4 to 6. John, you go.
Yeah, look, I mean, as I said, I think Casamigos was the outlier where I think we definitely took too much price COVID. We have course corrected that. I think in terms of the other brands that I spoke to, look, we're in 7-8 year declines. I always start with the proposition, right? And that is what we're getting, because that's really what the kind of core DNA of the brand, and so that's what we're going to overhaul. But then much more than just that, into the packaging, into the fundamental architecture of the brand. Flavors we got carried away on Smirnoff. I feel we got too focused on flavors and Crown to the detriment of the core. So if you've noticed, I haven't mentioned price, Sanjay, in any of those points. And that's why these brands need a bit of a fundamental reset. And that's why we've kind of given the expectations that we've given. I think that's much more important on the longer term declines that I've seen.
If I build on John's answer, look, we've been trying to leverage all of the capability of Diageo into North America. So we had a exec meeting. Our first exec meeting together was in North America, but we deliberately did it in a way where every person of the exec went to North America a couple of days earlier. I invited the other business group president to go to different parts of North America. Everybody else with their functional teams spend some time and then come and have a session with John, so that when John was saying, this is what I found, this is what I'm thinking, all of the exec were able and knowledgeable about North America. So we'd never done that as a team before, but how do we all lean in and help John? That led to a second session, which Christina, myself, Hannah, and John did with the team in North America, which the Diageo phrase for is a teardown, which is basically take the mix apart from the shelf back and look at every element. So we sat in and we did it. And for the 3 brands you're talking about, and that was product quality versus competition, price versus competition, proposition versus competition, packaging versus competition. So really took it apart bit by bit by bit by bit. And what John is sharing with you in a summarized phrase is saying, actually, it's not a price issue per se, it's a proposition issue. We've lost some of that focus, and we've not invested in the other elements of the mix commensurate with what we want at a time when there's been inflation in the category. So he's going to go back and fix the things which, from that teardown, look like being the big issues, and price wasn't one of them in those 3 brands. Okay? Your crystal ball?
My crystal ball
Years
is
5
a simple
to 25?
answer is yes. But why? if we are changing the way we're fundamentally looking at the spirits category and the premium beer category, spirits plus RTD, full portfolio, strong OBPPC, strong RGM capabilities, continuing to build on RGM, being surgical with where we see opportunities. Here, these are the interventions to actually broaden our portfolio. I think going forward, there will be opportunity as we're much more competitive, we're much more customer-centric to be able to continue driving value. And what does that mean? With that top-line growth, even if it stayed at that level, yeah, we should be able to support the mid-single-digit operating profit growth. And, keep in mind, productivity never ends. What we've done is some big interventions with Accelerate and now with the operating framework, right? That doesn't mean the mindset of continuing to improve and what we can drive from an efficiency and effectiveness purpose goes away. Is it going to be at the same scale? Absolutely not.
No, indeed. Trevor, do you have a microphone? You've had your hand up for a while, but not a microphone. There we go.
Thanks, Dave. Two questions, Dave. One is, of your three immediate priorities, I've heard a lot about number one, a lot about number three. My impression is slightly less on number two. We've touched on it indirectly around customer service levels and things, but a little bit less colour there. If that's a fair impression, maybe is more to come down the road on priority two? And second question is, you've highlighted, been through an awful lot very, very quickly, and there's probably an awful lot of hurt around. Are there things that you can do to help the organisation heal?
Okay, two things. I think when you're quite right. We've talked more about one and three than we have about two. Because when I think about two, Trevor, and how I want to have conversations with our customers, the conversation needs to be, what are our category strategies? How do we show up in the UK at Tesco and Sainsbury's and say, actually, this is what we are thinking about your category? We've never done that to you before. They've never looked at us before. So there's a real shared understanding of the category that needs to be built. So Dialan and I have been to both of the two customers I've talked to you about. We've talked to them both about the fact that we're going to come. But really, we need, what you've seen from Christine, is we have to have a point of view about the category. We have to have an innovation plan for the next, not just 6 months, but the next 3 years, and I talked about that earlier, before we can even engage top to top about that category. So it's there, but it's in time. We've got to get it. I don't want to show up when we're not ready, because that will just be a false start. I think in the immediate terms, it's actually how do we service our customers? Because to be honest, we used to have this rule in Tesco. We used to have this chart in Tesco, which is if you were outside the parameters of service, I don't want to talk to you about any innovation. I don't want to talk to you about anything about category development, because if you can't do the basics now, I don't want to talk to you about what wonderful things might happen tomorrow. And I think we have to make sure we earn the right from the service of the business today to go and have that conversation with them tomorrow. There's a lot, Ewan was very open, there's a lot of capability, information that we need to build inside Diageo before we're going to front up with people who are very data rich and very immediate in what they're going to need from us, and we can't disappoint when we go. So it's about timing, not a change in focus. Look, I think your second question, there is a lot of hurt, and it's a big change for Diageo. It is a big change for Diageo, so we shouldn't. What have we tried to do? Trevor, look, you've seen little bits here and there, but we deliberately chose not to make any announcements ourselves about the changes that we were making. We've very deliberately at every stage been very transparent with all of our people about the diagnosis of what the case for change was, about the fact that we were going to have to change. We then walked them through all of that. We were very open about the selection processes, and we've been very, very open. So now, everybody, if you ask people, people appreciate that, but when you come to the changes and the decisions, it's hard, right? It's really hard. So have we been as appropriate as we can be in the way that we thought about that restructuring? Yes, we have. Are we doing everything we can to help people through that transition? If it means they don't have a role with us, what else it is they could do? As I said to you before, the feedback we get universally, but don't just check with me, check with the others, is nobody's saying you're doing the wrong thing. I don't like it's happening to me, but you're not, doing the right thing. Everywhere else in the world, and I'll get myself into trouble for what I'm about to say, and in my experience of these things, being very open, being very honest, but being very quick is ultimately to the benefit of our colleagues. And if I think about Latin America, if I think about North America, it's been an engagement, it's through and it moves on, it's quicker. In Europe, the consultation process is really hard on our people. And I know it's supposed to be there to protect, but actually when you look at the stages, and there's very little we can do in that time period apart from, respect the process that's there. The thing that we are doing and the balancing is for the people who are staying, we're talking about that purpose and the business we're going to build, because there's a time when you have to focus very closely on the people who are leaving the organization, but there's also a time when you have to be very clear about the motivation of the people who are staying. And so trying to get that right. We are, and again, we've done a lot of communicating, it's very open. The thing I'm enjoying is the fact that Diageo colleagues who, when I started, people would say, you'll never get anything, nobody will ever ask you a question, we need to plant some, right? Nobody's holding back, right? The feedback mechanism is working really very well, so I know where the problems are. Natalie, we know we're getting that feedback. In most places, that's done already. In Europe, we're still in that consultation period. So we're doing what we can and trying to be as empathetic as we can as we walk through the change.
Thank you very much.
Yeah. One at the back and one here. We've gone over time, but given we've still got 8 minutes to the end, we'll try and keep going. Okay.
It's Sarah Simon from Morgan Stanley. I've got two very unrelated ones. The first one is you're obviously being quite explicit that you think this is really a cyclical issue. How do you explain the strength of Guinness 0.0 if there isn't a desire for drinking less? And should we interpret the fact you haven't talked about ritual or seedlip or anything as those are now de-emphasized? And the second question is around exceptionals, because if we look back at Diageo over the last 10 years, there's this constant restructuring and write-downs and cash outflows. In your remuneration, will you be remunerated on a pre or a post-exceptional basis? Because ROIC goes up the year after you've written something down. So I'm interested to know how you think about the impact or how you align with shareholders in that.
Okay.
Thanks.
Why don't I take the first, you have a go at the second? Because look, I think you've got different things going on. So let's just scale this very openly. When you look at no alcohol inside Diageo, 94% of it is zero Guinness. So if I look at, it's important we have it available. It's part of a category portfolio, so it's not deprioritized. Where it's relevant, it shows up. It's part of the category. But non-alc spirits is less than 1%. So it's there. We have it there. We will continue to, but it will be proportionate to that opportunity. I think what Guinness Zero is benefiting from is the power and the strength and the cultural relevance of the brand, the quality of the Zero versus, let's call it the parent brand, is exceptional. And that's not us talking, that's consumers feeding back. So people are they're still getting the taste and the experience they enjoy, and they can moderate it and they can stripe it and they can do things with it. So I think we're talking about two very, very different things. But the bit that we've got to keep reminding ourselves is non-alc spirits is still really very small. It's growing nicely, but it's growing from a very small base in a very limited geography. And so we just need to be proportionate in the way that we think about it.
To your question on incentives, we will not be incentivized to actually impair things and bring our ROIC down. So just to be clear, if it's a in-train LTIP award, we would actually neutralize for that. That would not be a benefit for a payout. Clearly, as you set the new targets, you would have a new invested capital base going forward, right? But that is on your new base going forward. So no incentives for that.
One more at the back, and I'm going to give you guys you two the last question. So I can't.
Thank you. Carlos Laboy at HSBC. We heard a lot about demand creation and about capital allocation. It was very helpful. But I was hoping you could expand a little bit more on demand fulfillment and about the reinforcing loops between your firm and third-party fulfillment distributors, right? Sorry. And how the culture you're trying to drive in the organization, how that plumbing works, how that gets down to how those relationships are managed and influenced, and maybe a little bit about the philosophy that you have about how you see that moving forward.
Okay. Why don't I start, and please add in terms of, look, if in that organization that we shared with you quickly at the start, you should have known that in the local organization, it's a customer service director. It's not a supply chain director. That's different. So at the place where the customers buy and where we service, the focus of all of that resource is on customer service. You and I think gave you the example in the UK that actually, when we look at what the loss is, actually it's that execution that's the problem. And I know because I've been involved in the UK, one of those was very specifically logistics and delivery routing and what have you. In the old model, that wouldn't have been a priority for that local supply chain director. In the new model, the customer service person absolutely needs to be fixing, working that out. And if it's through a partnership, through the partnership, if it's totally wholly owned, then in our own operation. So whether it is a third party or whether it's ours, the responsibility for the quality of those fulfillment type arrangements are with the local customer service director, he or she responsible for customer service, particularly when it comes to that final mile fulfillment. Okay? Got two more questions. Two gentlemen down here, and then you can close it. Have you got the mic? Good. Great stuff.
Lawrence Wyatt here at Barclays. Dave, you talked about a number of price repositionings that we've seen on a number of brands at Diageo and the success that that's brought. But how can you be confident that that price repositioning boost is going to be sustained after we've seen the sort of initial reaction from consumers from that price repositioning? And then Nick, when you joined Diageo and the original medium-term guidance was removed at that time, I seem to remember you talking about the lack of visibility in the market at the time and why it wouldn't make sense at that time to put a medium-term guidance in place. Could you compare how you see the visibility today versus how you've seen visibility in the spirits market over your time at Diageo?
So if I start, I think, look, when you get into the details of the interventions we're talking about, what you see is that most of the things that we're addressing are either, let's be candid, a place where we lost our discipline in relative pricing to the competitive set through some of the cycles that Hannah was talking about, and we've lost volume as a result of that. By going back and addressing those price positions, we've gone back and won, so far, the volume that we used to have, right, when we had the relative prices to the competitive set in the right place. Hypothesis, we'll see over time, is that actually having won that volume back, you keep that volume because you've kept the relative price in the same way. Easy example, because we're in the UK, Bell's versus Grouse. Anybody I speak to in Diageo, Paul, or anybody who's ever been, Bell's and Grouse should be here, right? Alan's smiling because he's the one who inherited the fact that suddenly we got a place where Bell's is here and Grouse is here, and we lost volume, right? Don't know all the decisions, know that he wasn't there, but that's where we are. We put it back at that right price. The volume growth on Bell's is significant. Will we keep that volume? The marketeer in me says we will, right? But time will tell.
So two things I would say to you. When I came in, I think, one, we had a algorithm that just no one believed in. So it was more important to withdraw that than keep that. It wasn't just about visibility. It was clearly, even if I had all the visibility, we weren't going to be making those numbers. So that was the real reason to pull that away, because that just literally dominated the conversation, right? I think from a visibility perspective, I think there's a couple of things I would call out. One, I think during the course of the last 18 months or so, there's been a lot of work that's been done on the rest of the world, and I'll come back to North America. And I think everything that we've been doing from a portfolio expansion perspective, from how we're thinking about that business without that margin percentage obsession, etc., you've seen how the rest of the world has performed, right? You've seen that over the last 18 months or so, right? And I think we have much better visibility when we think about those markets and what can be delivered there, right? North America, I don't think we have better visibility. And I think, what Hannah laid out for you is the most important piece of understanding what's happening with the consumer and what's causing that stress, right? Marry that up with how we see some of the self-inflicted issues and what we can do to try and control those and change, right, are things that we have within our control, right? So I think it's not so much about having this crystal ball and the visibility of the market. I think better data on the consumer side and understanding, and a better understanding of our issues in North America and what we can go after. Does that help?
Very good. Ladies and gents, thank you very much. We're going to cut it there. It's bang on 6 o'clock.
Oh, last one, Jen.
Oh, I did. Sorry. No, you're right. I did do. It was flashing at me. I was under pressure to the 6 o'clock. Please go ahead. Sorry.
Ross from BNP Paribas. I just actually want to follow up on Chris's earlier question about FX. Because I guess one of the historical attractions of the Diageo investment case was actually strong conversion from the organic numbers to your hard currency numbers. And if I look at your kind of new medium-term algorithm, it's clearly a bit more driven by the rest of the world, which obviously can be a bit more inflationary. So I just wonder if you could talk us through how you think about the kind of drop down from as you exit in FY 28, 29, when some of those hard currency cost savings are maybe reducing a little bit, how you're managing the business between aiming for organic growth versus aiming for dollar growth. And linked to that, just in the very simplified annual incentives that you have, is the revenue and EBIT, I assume that's based on organic numbers. Thank you.
So it's organic numbers, but including transaction exposure, all right? And quite honestly, right now, as I've said, we're trying to minimize what we can do from a net investment hedge perspective, liability management on translation. Translation risk does not go away, and we would not be speculative and start hedging for that, right? Mm-hmm. So we will continue to take the right actions to protect hard currency savings, hard currency delivery of earnings. Yeah. But to Dave's point, I mean, listen, hypothesizing now beyond 29, right, is a little early. We're going to deliver the savings. We feel good about what we can do over the next 3 years, and we'll continue to refine our view on how do we minimize the volatility through translation.
Yeah, I think that's right. Okay, I am going to cut it there. We're just past 6 o'clock, so we're 3 minutes late. Ladies and gents, a couple of quick things, if I may. First and foremost, thank you very much. We brought you in. We sat you in a room. We've given you a lot in the last 4 hours. The intention was to try and be as open and as transparent as we can be about what we know, what we're trying to do, in a way that helps you think through the investment case. So rather than just present at you to try and think about the questions you had, we hope it's been useful. I'm sure, hopefully you'll stay for the innovation showcase downstairs and a drink thereafter. Can I just put on record my thanks to the exec team, who was me talking, we've been busy in the first 6 months. We've all been very busy, and as a team, I'm very delighted that we've got ourselves here. We are all very clear we've got a lot to do, but please, please, please take the opportunity to talk to them in the showcase. 2 practical things, if I may. When you go downstairs, you need to take all your things with you, because this room will be stripped while you're gone. So please don't leave anything up here, because who knows where it might end up, right? So take your stuff with you. Second thing, when you go downstairs, please be disciplined and make sure you don't just stop at the Guinness tap, okay? So please go and have a look at all the innovation that's down there, and we'll see you back here in 30 minutes. Okay, thank you very much.